Hi, I'm Melissa Heaney with Stuart Peterson Group. We are a risk management company out of West Bend, Wisconsin, and we work with farmers like yourself in managing the risks that they face every day with the volatility in the markets. This presentation was shared by our company at the World Dairy Expo this year, and here's your opportunity to get some great insight on what you need to know going into 2015.
Please take a moment to read the following important information.
The agenda for this presentation is as follows. I will start by giving you a simplistic review of what we were discussing this time last year and what we were expecting the milk market to do going into 2014. Following that, I'm going to be discussing price scenarios for both milk and feed for coming into this year, 2015. This is a second month continuous weekly chart for Class 3 milk. Each bar on this chart represents a week of trade. The milk market during 2013 and going into 2014 was really a unique setup. As you can see from this chart, which goes back about 7 years, the milk market is typically a trendy market. We typically do not see a lot of quiet, sideways price patterns for as long as we did during the 2013 year. Sideways patterns, though, can be a very great signal when understanding how much opportunity or risk might be coming our way. With any market, the longer and tighter that market trades in a sideways pattern, the stronger the breakout of that trade range can be. So as you can see from this chart, the Class 3 milk market was trading in about a $2.50 range for a while, with $16.88 on the bottom of that range and $19.50 on the top side of that range. So if we take that $2.50 spread and we add that to the top side of the range, we knew that our top side objective would be about $22 milk. And by taking that $2.50 spread and subtracting it from the bottom of that range, essentially we know that our downside objective would be about $14.50 milk. In 2013, there were a lot of factors that really could have drove the market either way. So what we really needed to do was be prepared if we were going to have a breakout to the upside or to the downside. As you can see here from this chart, and as you know, we saw that upside breakout. And not only did we go to $22 milk, we went past $24 milk. So with record prices, there's no doubt that we are going to see some pressure in Class 3 milk in 2015. And one of the main factors that point us to lower Class 3 milk prices in 2015 is international prices. This chart here is comparing the global dairy trade butter price to the CME spot butter price. Since February of 2013 to April of this year, the global dairy trade butter, which is the blue line, has held a premium to CME spot butter price, which is the red line. But for most of the part, the two have trended very closely to one another. Then, starting in April of 2014, you can see here that the world markets were becoming very depressed and CME prices continued to rise. There is absolutely no doubt that this 170% markup that CME has over the world is going to be devastating to our export demand. So let's take a look here at some cheddar prices. You're looking at a very similar dynamic here where CME and the global dairy trade cheddar prices trended pretty close to each other up to June, where then they went in completely different directions. So now the CME price now holds over a 70% markup to world cheddar prices. There has been times where the world market had a premium over CME and vice versa. But what's important to point out here is that the severe divergence will be fixed and prices will eventually come back together. So in addition to this, the US dollar is now starting to see a breakout to the upside of a really tight range it has been trading for over the last 3 years. As of the end of this last September, we are seeing the dollar at a 4-year high. So if this dollar is looking at a first bull market in about the first one we've seen in about the last 12 years, it will be hard for milk prices to hold where they have been. From a fundamental standpoint, you can see here what the dollar is doing versus dairy exports. The dollar is the red line and the U.S. exports is the area shaded in blue. This chart displays the dollar index going back from about 1995, and you can see here that from 2004 to 2014, exports remained very strong as the dollar was cheap. From 1995 to 2004, there were some exports going out during that bull market. However, metrics are not displayed on this chart. The average in that time frame was about 10,000 metric tons of dairy products per year that were shipped to other countries during that time frame. But the most important thing to point out here is we have been a main source for other countries when the dollar remains cheap. And now with the dollar rising, there is no doubt that our export business for dairy will slow down. This next chart displays the average price for Class 3 milk from January to December from 1998 to 2014. This chart here strictly shows the future average prices. So for example, in 1998 the average Class 3 milk price was $14.20, in 1999 it was $12.43, and in 2000 it was $9.74. As of 2014, the Class 3 price is around the $22.50 range. So when we look at where we have seen a pullback in the milk market, you can see that there were a few years where we had a pretty dramatic pullback that happened just in 1 year. So for example, if we take a look at 2001 to 2002, we had a 20% decrease in the average milk price in 1 year. The other scenario that played out is when you look at 2007, where the average milk price was $18.04. Then we had a pretty modest drop to 2008. But then we had a very rough drop from 2008 to 2009, where the 2 year of losses we were down a total of 37%. We know that prices will come down this year, and we already see that milk prices going out into 2015. The big question is, will we see a big drop in 2015 similar to 2001, or will we see a scenario like 2007 to 2009 where the first year wasn't as rough as the second year, and 2015 will mostly be quiet, maybe some more sideways trade, but then in 2016 is where we will see a dramatic decrease in Class 3 milk. It's hard to say, but looking at history, either scenario really could come into play, and that is exactly what all dairy producers need to be prepared for. So in summary, when we look at where international prices are compared to our prices, we have the dollar strengthening and our historical average price patterns. There is some price risk for Class 3 milk that will come into play in the next year or 2 years. Now is the right time to start thinking about how you're going to protect your revenue stream. So now let's shift from milk to feed. So what is on everyone's mind right now when they talk about feed prices? You are exactly right. Record crops. When there are record crops, people start believing that prices will be lower and more stable for the next couple of years. However, when we look at history, this doesn't necessarily hold true. And that shows in this next chart. This chart here is a front month continuous chart for corn futures. Each bar represents a month of trade. And so each red arrow here points out when we have seen higher yields than we had ever seen before. You can see here where record crop has come in during a major low in the market. 1985 is the only year where there was a record crop and then the market went lower. With the exception of 1985, all the other years we had a record crop, we had very little downside to a lot of upside that following year. Let's take a closer look at some numbers. This first column here is the year the record crop was harvested. The second column is the low price that came in between July 1st and December 31st of that year that record crop was harvested. And then the high price listed is the high price that corn hit the following year. You can see here that there are some huge up years after a record crop. Out of the years that were listed, the average rally in price is 72%. The minimum move we saw was a 17% rally, and the largest rally we saw in price after a record crop year was 181%. So if corn saw a low, let's just say of $3.25 this year, that means if we take the 72% average, again, just an average price move, we could eventually see about $5.50 corn. One more thing to add to corn here is taking a look at the ending stocks. We have more corn than there has ever been when we look at ending stocks. In fact, we are looking at having over 2 billion bushels of corn. It sounds great when you're looking at just the supply side of the equation. However, if we pull in the demand side, the stocks-to-usage ratio is at 15%. That means the total stocks we have is only 15% of our total demand. Take a look at 2009. That was the last record crop year, and the stocks-to-usage ratio was at 13%. Look at what we saw. We saw a lot of upside that following year. Again, just because it's a record crop year does not guarantee that low prices are going to be around. The same holds true for beans. Similar to the chart I just went over on corn, the year is the column that states the year the record crop was harvested. The low price is a low that soybean meal prices saw the year that record crop would have been harvested, and then again the highest price meal saw the following year. So you can see again here that there's some huge moves to the upside the following year. Average increase in meal is 81%. So let's just say we saw $300 a ton as a low this year. It tells us that we could see some higher prices come next year. So let's just say we took that 81% average increase. We could see meal around the $540 a ton. This is based off of what prices have done historically and does not guarantee any price moves, but tells us that there is some good amount of risk and a good chance that low prices might not be around. One important thing to note in what we are watching is that soybean meal could have some potential to move slightly lower before we see higher prices. And we can see that by looking at the soybean to corn ratio. You get that by taking the front month futures soybean price and then dividing that by the front month futures corn price. So if the value of 3 means that soybeans are 3 times the value of corn, and when it's 2, soybeans are 2 times the value of corn. When you see 2 or lower, that's typically when you see soybeans are undervalued to corn. Beans are currently overvalued to corn right now with the ratio at about 280, and we need to see that ratio correct to about 250 being a long-term average. Again, for this ratio to correct, we could see some more downside price action in beans yet. This does tell us that beans can have some downside, but don't lose sight that once that corrects, we could face some risk to the upside, like we saw in the previous chart. So now that you know that both milk prices and feed prices are at risk going into 2015, have you thought about how you're going to prepare yourself for the worst case scenario? Want to learn more on how we can help you prepare for the risk that lies ahead? Feel free to contact me at 262-438-0324, or you can email me at mheaney@stewartpeterson.com. Thank you for your time.